everyone. Thank you for joining me today for our panel on Angel Group and Angel Due Diligence. I have Allison Silvers. She is with executive committee member of the Techos Angel Group on the West Coast, and she is based out of Los Angeles. She is also a mentor and advisor and an early stage investor herself. I've got Joseph Liu. He is a board member of the Central Texas Angel Group. And he is also on the investment committee and an experienced angel investor. And I have Connor Paskoff, who is with the Baltimore Angel Group as an analyst. And he has done due diligence. So thank you, everyone, for participating today. And would love to kind of have you tell the audience a little bit more about your group, how big your group is. We'll start with Allison. If you could tell us a little bit more about Techos Angels, your membership, and if there's any industries you kind of focus on or stages, that would be great.
Absolutely. So Techos Angels is based out of Southern California. We have 4 chapters right now over several different geographies. I'm part of the Los Angeles group. We also have other areas, including San Diego, OC, and so on. So we have in total about 425 members currently, and our members come from a variety of backgrounds. And we also invest in a variety of industries, mostly at the early stages. And a lot of my answers will probably say it depends, because TCA members have lots of different interests and different ways of thinking. So we're not all under one unified viewpoint. So I can talk more about that as we go along. Pleasure to be here.
Sure. So you're fairly industry agnostic then. Your members are investing in a lot of different industries.
That's correct.
Okay, perfect. Okay, Connor, I'll ask you about Baltimore Angels.
Yeah, so the Baltimore Angels Fund, it's a group of high net worth individuals, really spun out of kind of a think tank, kind of just a group who really wanted to get more structured. So really, by doing that, we really spun up a Series LLC fund. So that gives us the opportunity to take all the different investors. So we can, from any time active 25 up to 150 active investors on pitch meetings at events, talking to companies. And through that, we make it easy for the companies, because we spin up that Series LLC, allows us to invest one line on a cap table, really simple that way. Makes it easy for the company, easier for us on our tax setting. We're really industry agnostic. We had a big focus on SaaS-based companies, obviously, high returns there. But, being in the Baltimore area, we did do a lot of impact investment, looking into minority-owned businesses. But, we don't strictly stick to Baltimore. We are across the country, but we try to stay in the Mid-Atlantic region. Typically check sizes range anywhere from 100 to 250, but we've even put 500,000 into businesses. Right now our IRR is about 70% return. So we've been doing very well, and kept it going during the pandemic, and everything's been great, and I'm excited to talk more about it.
Okay, perfect. And Joseph, can you tell us a little bit about Central Texas Angel Network and the members, their interests, and stage typically that does the best?
Central Texas Angel Network is based in Austin, Texas. And in the past 5 years, our average memberships is around 150 memberships, and we have some family members. So our members around 150 to 200 members in the past few years. And we have members from all over the country, mostly from Central Texas area, but we have members from San Antonio, from California, from New York, from the East Coast, from Baltimore, and we have members from all of the country. And some of our members have multiple memberships in various angel networks. And we are industry agnostic. So we divide the main interest groups into B2B software, B2C software, life science, CPG, and hardware including advanced materials, chemicals. So we've invested in various industries.
Got it. Okay. All right, great. And next, I'd like to kind of talk about your the process for accepting deal flow. So we'll kind of go the other way around. Joseph, what is the process if an company is wanting to or interesting is raising money with the Central Texas Angel Group? What's the process they have to go through?
So the step one is go to CTAN.com, and I welcome every entrepreneur to apply to CTAN.com. And the website is very straightforward. We have two tabs, entrepreneur tabs and investor tab. So the first step is the submission your application, and CTAN has 6 funding cycles every year. And the first step is apply on the website. There's a form you fill out, the background, basic information and how much money you're raising and what's your traction and what is the valuation, this kind of information. I think the information CTAN is asking is common, like every angel network we're asking. So the first step is on-paper screening. So CTAN is for volunteer, all accredited angel investors. So we advance a deal based on members' interest. Every member has one vote on the selection process. So the first step is on-paper screening. Members vote on the deals they are interested to have an understanding. The second step is a presentation. Because of COVID and the end of COVID, so now we have a hybrid model. In the second step, it's an in-person presentation and online presentation. And most of our members appreciate in-person communication in the network event. So the second step is a presentation stage. After the presentation, we have another vote, and then we advance the company to the next round. Then we do the due diligence. Meanwhile, we collect the interest level of the member and how much money a member might invest. So we have a ballpark figure. How much money we may fill in this round, and meanwhile we can syndicate to our friends like Techos, and we can share deals and process the flow for startup companies. And
Okay. Oh, sorry. Okay, well, we'll dive into it a little bit more in terms of the diligence that goes on. I'd love to hear from Connor. Is it a similar process or is it different at all?
Yeah, I mean, it's pretty similar. Obviously, we get a lot of inbound leads, definitely a lot of referrals from, other investors, a lot of different angels in our group saying, look at this company, look at that company. They might align with, something else in their portfolio. So a lot of inbound leads. If you are interested in applying, you can go to baltimoreangels.com or shoot an email at analyst@baltimoreangels.com. I recommend a really good pitch deck. If you have a data room, send that over. That's really where we like to start. My goal is we get as the analyst, emails would come in with the pitch decks. My job, review the pitch decks. A lot of the times they just get thrown out immediately for whatever reason. If they're not aligned right, they're blurry, they're unprofessional, whatever that looks. So, come with a high quality pitch deck that tells a story. If you have a data room, share that, because I'm going to open the pitch deck. I'm going to open the data room. I'm going to make sure that your company is hitting on its targets. We invest in revenue generating companies that are already in a round that, we're never going to be a lead investor in a round, but we definitely want to pick up that last slack and put in money. But, ultimately, deal flow comes in, review the pitch deck, data room. If we think it's a good business, we'll talk internally to the director of operations, managing partner. If we think it's a good business, then we'll hop on an interview with the owners, founders, advisors of that company, have them pitch us, do our due diligence, talk about them. And then, if we think they're a good business, we like what they do, we like their founders, we really dive more into that data room. We'll start conducting interviews with their team internally, with customers and clients. And we really then just try to make an informed decision if they're, a good company, if they hit our metrics. And we use a 20-step criteria for due diligence, which I'll talk about later.
We'll talk about
that later. But, if they're hitting on our points, it's a score system. So if they're ranked above like a 70 is how we rate it. They're, an investment grade a company, and then we'll present them to the group of angels. So, that's kind of like herding cats in a sense, where it's, get all the 50, 100 angels in front of you, and you come and you pitch them. We kind of changed our model around because of COVID. It used to be, once a month we bring in 3 or 4 companies. It'd be like a 3 or 4 hour, evening, and you kind of had to, like Techstars, you had to kind of convince them that you're the best company out there, get the people to invest. And it was really competitive. It was long, drawn out. Investors started to lose interest. So we kind of took that online model and just bring one company in front of the investors, give them that floor and let the investors kind of go after it. Yeah, and then I can talk more about the diligence.
Yeah, it's interesting, the contrast, because I think the way that CTAN does it is kind of having members vote to determine the members' interests, and then the highest voting companies then make it to due diligence. And it sounds like what you do is you kind of do a little bit of due diligence on the front end, and because you're a fund, you kind of have a checklist and criteria, and then put those companies out to the angels. So that's interesting.
Yeah, absolutely. And I mean, the thing with the members of the group, they're busy people, they're CEOs, they're executives. They don't have the time to do the due diligence. So they trust our team, our managing partners, to present them with the best companies. They give the pitch. If we do follow-up questions after that, we try to just raise money from them. And so it can be 5 investors, it can be 50 investors. And again, we go, one line on the cap table, and it's a pretty seamless process, and it seemed to be, doing great.
Got it. And so, Allison, I'm curious to hear about, how often do companies get an opportunity to apply, and what that voting process looks like, or that screening process, I should say, with Techos Angels.
So, I think there's some similarities in what was just discussed. The first point often is go to our website and apply. It's Techos Angels has a phenomenal website with a lot of resources. And I'd encourage founders to go check that out, even before applying and before submitting their deck, because there's guidelines that even tell you what we're looking for, tips on what to include in your deck and presentations. And so on. So I think that that's a great starting place. And you go from there. After that initial application, there's a pre-screening committee, and that is a smaller committee of TCA members, all volunteers, that go and do the initial review. And from there, the next stage is the screening meeting. And that is where the founding team presents to the Techos Angels team. And again, it's separated by geography. So for instance, I'm Los Angeles, they would present to the Los Angeles team. Sometimes if a company is well-liked or whatever it is, they might present to another region as well, but they usually start with one geography first. And after that initial meeting where they're presenting to the whole group, if there is enough interest, they go on to due diligence, and the due diligence is led by members. We encourage our members to be active. There's due diligence leads. I won't go too far into details there because I know that's a separate question, but we also have a team of analysts that partner with us that are usually current students or whatnot that help us in that process. But the angels are the ones that are really, diving deep and talking to the founders and getting the information and analysis. But hopefully that answers some questions.
Does your and so the people that volunteer, the angel members that volunteer to be in the due diligence, are these the same group of angels, or do they really kind of vary by deal? And are the angels, how many people are usually involved in the due diligence at that point? If you could talk a bit more.
So usually, if you are interested in investing in a company and you've gotten to that point where it's now due diligence, you become a member of the due diligence team, and then we have a lead or a co-lead that also is kind of the front of the group, and they're the ones that are corresponding, making sure we're asking all the questions of the group and getting the information. But really, anyone that is a member can be a due diligence lead, and then we encourage everyone to take a turn being a lead. And some members have been there longer than others and might teach the newer members the ropes, and that way you have a lead and a co-lead. But again, I think it's something that everyone pretty much takes a turn doing. At least we like to encourage that.
That's great. And a follow-up question, and then I'll kind of go on to the others. As this due diligence is conducted, typically, how does that look? What is the time frame? And are there others outside? How much information is kind of from internally, and then how much is derived externally? And then I would imagine from that you write up a deal memo. Is that pretty much? Yeah.
Yeah, and I'm gonna use my answer again. It depends, right? I think that some companies come with a lot more information than others. So, for instance, if we got a company referred by another angel group, maybe the founder and the other angel group said, here's the information we've already provided them, and so on. So we share information to try to minimize work for everyone involved. And we really like to be respectful to all parties and try to make the process as fast as possible. There's a lot of people involved, lots of moving parts, but we actually have a due diligence committee within TCA that really focuses on, continuous improvement. How do we make due diligence as best as possible for all parties? And that's something that I think is really valuable for us as well. I think you asked a couple other questions and I don't remember.
I know I have to stop with the multi-layered questions because I don't remember either, but I'm sure we'll get back to them. But no, the due diligence committee sounds like a great thing. I'd love to, if you could elaborate on just one thing that was an improvement from that, in due diligence that you've seen or that resulted over time.
Yeah, absolutely. And there's lots of components to it, from education, and I think having sort of questions or focus areas to say, these are things that we should make sure that we're touching on. So we're not recreating the wheel each time. And I think that helps speeds up the process, as well as targeted timelines. And I think that that's helpful.
Got it. Okay. All right. So Connor, you had talked about, you had, I think it was 20 different checkpoints or maybe in your due diligence. I may have gotten that wrong, but you have a process for your due diligence. Can you touch upon that and what some of those things that you look for are, what some of those different criteria of due diligence?
Yeah, absolutely. As I mentioned earlier, the biggest thing to start off with is, the pitch deck's got to be clean. It's got to be great. And then you got to provide a data room, within that, financials, profit and loss, cap table, balance sheet, all of that, our customer feedback reviews, legal documents, tax returns if you have them, business plans, marketing strategy, the product roadmap, your sales strategy and pipeline. I want to know, where your traction is going to be. If you have any IP documents, patents like that, any term sheets from the past, want to get all that information in the data room. But yeah, we at the Baltimore Angels use a custom score sheet that we put together over the years. And it's really 20 different criteria. It's like 100 points. And it really breaks down in the high level traction, value proposition. And, at the high level, again, traction, value proposition, the value of the revenue and its scalability, technology and its competitors, team, and then, valuation, use of funds. And then, just to go into those a little bit. So, really what we're trying to look in for, traction and valuation, it's, the types of partners you can make. Is it B2B? Is it B2C enterprise? Are you going to get these big deals, or is it these one-off small type, subscription models? What is it like? How are you doing historically? What are the sales cycles? Is it a lot of inbound leads, a lot of outbound leads? Is your sales team really having to go out and prospect, or, do you have a great product that people were talking about and getting other people coming in and wanting to try out your product? We look at the pilot status, how that's going. What's the retention? We're always looking at, companies with a 90+% retention rate. Obviously, we had a big focus in SaaS business. So, that was high, needed a high retention rate. And then with that, on top of that, that ability to upsell, you want to be able to increase the price of your product. You want to be able to sell, to larger organizations, or as organizations scale, be able to upsell that part. And then under that, really just your existing traction. Have you been hitting your projections? Are you really getting to where you're trying to convince me you're getting? And are you doing that, under, the value of the revenue? What are your product margins? If you're a SaaS company now and your margins are at 40% and, you got to get to 70, 80% for us to want to get there. Obviously, it takes some time. We look at, customer acquisition costs, lifetime value, marketing size, and competitive.
The question that comes to mind as you're explaining all these different sections, and this sounds really comprehensive and like a very good process. How does it, like, if you had a company that was say at the Series A stage, they're going to have a lot more traction than, say, for example, a much earlier company. Now, it may be that you're not any company that's pre-revenue, because maybe that's not companies that you generally would advance. But is there any kind of, I guess, weight put on, say, patents, for example, if there's a patent there, or, perhaps their earlier stage? So how do you account for those differences in valuations, or those differences in your overall score that you come up with when you're ranking the companies?
Yeah, I mean, it's definitely more difficult to kind of, value a patent. Obviously, if they have few patents, they own the proprietary information. It's their product. No one can go out and steal it for 20, 30 years. You definitely have to put a weight for that. One of the things we really look at is that patent, replicable, and just kind of a slight different way. And we, talk to teams. We have in our fund, we have different, lawyers, patent experts. So, I'll be able to go out and ask some of the members of the organization, what do you think about these patents or some of this IP? You work in cybersecurity, you're a cybersecurity expert. Have you seen this? Have you done that? And we do definitely put higher weight and higher scoring on that. But valuation wise, it's definitely hard to, kind of comprehend, what the patent really is worth without, kind of, can they sell it off? How's that business kind of running? So, once they're a Series A and they've gotten the traction and they've gotten the revenue, it's definitely a lot easier to see the value of that patent, and other people that can't get into that business really looking at the competitiveness. If they're the only one in that market because of that patent, that that no one can get into their space, they're going to be the leader for the next few years. So that definitely starts to have
in your sections, the 20 different sections you look at, is valuation one of the sections, or does that come into play? And then how do you I guess, does it vary from one industry to the next? Meaning, do you find that there's certain valuations that are acceptable, say in life sciences, of course, than if you have the same valuation at the same stage for CPG? And can you elaborate on that a bit?
Yeah, so we usually, valuation is definitely one of the metrics that we follow. We usually look at comparables, what industry you're in, and kind of trying to put a exit multiple and something like that. EV to EBITDA, if they're a profitable company, excuse me. If it's just revenue metrics, we're trying to just kind of take industry averages, trying to understand where we think this business is going to go, and then kind of just looking at month over month growth, where they've been in the next few years, what's their sales pipeline, and trying to kind of back into a number there. And again, we're trying to hit 60, 70% IRR. So we kind of take it from this, backwards approach of, we need to get here, and how is this company going to get there? How much is their sales going to have to be? Where do they have to hit? What metrics? And then, with even in the valuation, we look at, burn rate and salaries. If a CEO is trying to raise, $1 million, and he's taking home 150K off the top, that's not great. Another thing we look at is really just the team, the ability to sell and hustle. If they know the market, if it's someone that's built up a business in a similar market and exited, we're going to, give them a little bit more of a bump because of that domain expertise. If they have, realistic exit goals, if they're coming in, they have no real revenue, if they've made 150K, year to date, or, lifetime, and they throw up a $10 million valuation, it can really throw investors, analysts off when you don't really align your valuation with what you guys are trying to do.
Got it. Got it. No, that makes a lot of sense. Joseph, in your, experience with due diligence and being on a due diligence team, even, what types of red flags did you experience, or would you think would be something that would cause either you or the team to maybe walk away from the deal?
Thank you, Laurie. So first of all, I want to recap the CTAN cycle. So from the application to make the investment decision, the total time frame around 13 weeks. We try to manage this within 13 weeks. So multiple rounds, including due diligence. So, and again, in CTAN, we are all volunteer and we are independent investors. So we invest as individuals. So the purpose is not to rank the winner of the cycle. The purpose is to provide enough information by the due diligence team to help each member to make the investment decision. So in our members construction, we may have members, they do not have the interest in the deal, but they still volunteer. So we always have the same member volunteer to do the patent check. He's a patent lawyer. So of course, he's our go-to person to check patents. And we have a different expert. Usually an expert may not be interested in the same industry he's in. So, but we have the person in the due diligence team to work with. So when we do this, it's not check on all the boxes. It's we look for, like Laurie mentioned, the red flag we're looking for. What are the deal breakers? So deal breaker may reside in any sections. So give an example. If we tier every section of the due diligence report from tier 1 to tier 5 score, if we find something is fishy, it's not credible, then we put 1, and that's a deal breaker. So it's not a decision based on the total score or the balance, the average. It's we provide this due diligence team provide this information to every members to look at. This is our memo. This is based on our research, and this is what the team found. So, for example, deal breaker. A CEO may one example. Entrepreneur may claim he had a previous exit experience. So when we interview with the former companies, then we realize he was part of the team. He wasn't on the C-suite. So that's a false claim. It may or may not be a deal breaker, but we just disclose this information. So for some investors, this is a deal breaker because this is a sales mentality. We don't like it. So there are different coachability could be a thing. Some experienced CEO, they are the expert in the industry, but they're not coachable. So in the due diligence conversation, they just keep arguing. They're not thinking. They're not listening. So it might be a deal breaker for some investors. So on the due diligence thing, I've seen various deal breakers for different type of investors.
Got it. No, that was a good answer. Let me ask you kind of a follow-up question. Have you, based on the experience of going through and developing sort of just experience under your belt over several years, how has that changed perhaps the way you invest or your tolerance for getting in? Has it changed at all the criteria that you use when you look at a company for your investment? Have you changed sort of your criteria over the years since you started?
Yes, I changed quite a bit. So I remember when I first joined CTAN and joined the first few due diligence or the first pitch night, I was like into a candy store. Every deal looked so good. I wish I had more money. I want to invest in every company. So through the due diligence,
I'd like to be an entrepreneur there.
Yeah, and so that's as an angel investor, that's the value I see to participate and volunteer in a due diligence team because I can learn from other fellow investors. So I changed my criteria. So in the past, I'm looking for two things. One is compelling reason to invest. And the other thing is to eliminate all the possible red flags and the risk. So take a football team, for example. I need a strong defense and I need a strong offense. So I need to balance two things. So I have two lenses, look at two things together. So a strong offense could be, is a great market. It's a great solution. It's a great deal. So sometimes it's a good business, good idea, but the valuation is too high. It's not a good deal for me, or it's a later stage. So there are many reasons. I'm looking for a compelling reason to invest. One of my compelling reasons might be Laurie is in the deal, and I trust Laurie so much, so I'm in the deal. Or it's a syndication deal from Allison, and I like it. So this one is compelling reason. The other is I have to check on my tolerance. So am I comfortable with this plan? Am I comfortable with the sales growth? Am I comfortable with the potential exit? So in the beginning, I have an MBA. In my academia background is looking for the exit opportunities. So I didn't like niche market because it's very narrow, right? So every entrepreneur pitched the 10. So if it's a very small 10, very niche, it kind of limited my exit options. Later on, I learned actually niche market or niche solution may lead to quick exit. So that's one thing I learned over the years. So like Allison said, it depends.
Okay. Connor, with and it's going to be different because you obviously an analyst, but over the years, had you found anything that kind of shaped, just doing the due diligence that you've changed or improved upon or shaped you as an individual investor?
Yeah, I think just like Joseph said, when you first start, you're just like, every company is the best. Like, this is going to change the world. Like, their projections are amazing. Like, how they're going to hit these targets. And then, I just came from a startup where I was doing like head of sales, and you realize that, what people are saying, what founders are saying, it's a sales pitch, and you have to really get into the weeds. You have to really take a step back and not get excited, because there are thousands of companies out there. They're all claiming to change the world. So you really have to, it's where we try to invest in these early stage revenue generating companies that just need that leg up to get to the growth, to exit in 2 to 3 years. It's really a gut feel. It's, what's their product? Do they have the traction? And it's, really, is the leader, the CEO, is he going to go out and convince the other people, the people on my side of the table, that his company is going to change the world, and raise that money and then exit within 2 to 3 years and get us, get our investors paid? So it's really kind of that gut feeling, and kind of taking a step back of realizing that, it's not every company is going to be great, and just really just figuring that out and being, I don't hate to say mean, but like, not just like, you're going to be great, you're going to be great. It's nice to tell them that you're going to be successful and to keep working at it. You need to do these things. But I mean, you really need to just be focused on, what do you see in the next 3 to 5 years this company is going to do, and how is it going to get there better than these other companies? A lot of things we do is like, look at, are their competitors well funded? Are they agile? And to Joseph's point, are they niche enough that like a company is going to come and eat them up and just integrate their product into what they're at, like, and what their other offerings are, and kind of do that merger? And that's really what we're looking for, is, can this business fit into some other business really well? Because we're not going to take a business from start to IPO. We don't want to be in there. So can we find a business that's doing well now? Is their founder hungry, and is he going to go kill it? And let's get out of there in 2 to 3 years. So it definitely changed over the years.
Yeah, no, that's great. Allison, I know with you being sort of not only an investor within Techos, but also a mentor, yourself mentoring companies, I'm curious to see what your sort of learnings are and how has it shaped your personal investing decisions.
Absolutely. I think that there's a lot of factors that one needs to consider. And over the years, I think really having a good understanding of the founder and the founding team is something that's very important. I like to get to know people. And I think that really making sure that this is the founder that is right for, this startup or the founding team, like they are going to succeed and they are going to succeed no matter what. And at the same time, be coachable, determined, and have all of the right characteristics required to make everyone, win. And I think that's really important. And sometimes that's not emphasized enough. There's also lots of other things that I look for as well in the due diligence process that have been mentioned. And I think just really testing assumptions and making sure that, what's put in front of you is really well thought out. Because I think that sometimes, for instance, like let's take a financial model. A founder might say, I'm not really sure, is this right? I said, half the time you don't know what you're going to be making in 10 years, 5 years. But what an investor wants to know is how well thought out this is. What are your assumptions behind it? Can they trust the way you think? And so I think, those findings or coming and really thinking through that and seeing the way people think is important, and things that I like to look for or help people with. And sometimes it's okay not to know the answer, but making sure that you're also honest, and honesty is very important. That's a characteristic I very much look for in people.
Yeah, I think it's the process, the thinking through, and thinking through what the strategy is and thinking through the process is actually more important than the answer, because the answer may change or may not be.
It will probably change.
Right.
Yeah.
But
and I also.
Yeah, go ahead.
I was going to say, jump in there that Allison saying with just the assumptions. So you'll get a pitch deck in front of you, and they're looking at their total addressable market, and it's the entire world, and it's hundreds of billions of dollars, and you're like, this is not achievable. Like, you work in this one little space, and you're trying to sell delivery pharmacy equipment in just Boston, and that's might not scale, and but it could be good, but you're not going to hit the entire world. The people in Uganda are not going to be using your pharmacy delivery service. Like, it's not going to happen. And you have to be realistic there.
Right. Now, those are all great points, which leads me to my almost second from last question is, can you think of kind of given all of those great points that were made, and I'll go to Joseph first, a company that maybe either well, Joseph, you have some exits. Can you think of a company that did really well? And, were these factors in place? Did you know that they were going to be a winner, and what about them what characteristics led you to see that? Or is it purely a game of numbers, meaning that if you invest in enough companies, 20 companies, that maybe 2 of those will have an exit? So can you kind of shed some light on your thoughts towards that?
I think there are some one or two factors can make a company successful, and 1 or 2 factors may make a company fail. So some of my experience, I think the successful experience come from I believe in let me answer the other way. So when the company was asked about what's your revenue, what's your trailing revenue, what's your traction, or pre-revenue, post-revenue, this question, the hidden question, implied question is the confidence of the market validation, right? So if you do not have the answer upfront, but if you can validate there's a market, or you can use some happy customer survey or something to validate this may lead to your future exit. So I have a company, when I first invest, there was no traction, pre-revenue, pre-product. And of course, we ask the question, and we have huge concern about the product risk. And it's a aerospace company. And the company shows we have this progression with NASA, with Navy, and we have DOD. So it's not a traction per se or a revenue, but they show some validation. So I think the CEO answered the question. They understand the question behind the question, and they address the concern. So when they answer this question and I see they move along and the CEO perceive the true concern behind the questions and they can fix this question and address, and they give the investor confidence. The CEO knows how to manage the business. So I like those CEOs who can understand the meaning of this. And like Allison said, it's okay, you don't know the answer, but being coachable and come back to us or find someone who can answer. We don't expect CEO knows everything. If you don't know the number, you don't understand the term, find a CFO. It's fine. That's CFO's job. So, but the interaction is very important.
Got it. Allison, I'm going to go to you next, and just, you don't have to give any names, but just think about a company that, either exited or maybe alternatively failed. And, what were some of the characteristics that led to that outcome?
Sure. I think some of the same characteristics, but either the positive or the negative sometimes determines failure or success. So I think focus is one of them. Sometimes startups take on too much and they want to do everything. And you really need to be strategic in your path. And sometimes founders or founding teams that really try to take on too much and maybe don't spend wisely, don't spend their money or time wisely or resources, they might fail. Or others that are very strategic in their path to success while still navigating new things that come up and maybe changing paths a couple times, but achieve and get to value is something that's, will ultimately lead to hopefully success. But I think unfocused startups maybe that are just drowning and trying to do too much, like that's not usually the recipe for success. And again, I'm going to go back to the team and making sure that you have a good founder, leader, and team with you to navigate that. And that also goes for the people that you surround yourself with, not just the founder or the co-founder, but your mentors, your advisors, your employees, the people that you look to. I think that you want to keep yourself challenged and honest and getting as much information as you can, and experts, right? So whatever you need to get as much information to, and sometimes maybe even someone just say, hey, you need to focus better, like let's get back on that path, because sometimes it's hard. And so looking at all those components in a team and a founder as early as you can to try to figure out, can they do this? And sometimes, and I'm not talking now on behalf of TCA, but in general, I sometimes get to know companies. Maybe they're not ready to raise, and I get to know them early on, and I see the way they think, and it's nice. And a lot of investors like to form relationships with founders to help them along the way and figure out, is this a good fit for both of us? I think that's also great.
Yeah, no, great. And Connor, is there anything that you'd like to add to that? Those were both great.
No, not much to add. I think, focus, coachability, are they ethical? Are they going to hire a good team? Are they going to streamline the process? And, are they going to, go and hit those targets? Are they going to be, I don't want to say narrow-minded, but again, focused on what they're accomplishing. One of the things I would always ask when I was interviewing or, during the pitches was, we're doing this. And I'm like, well, couldn't you take this horizontal or go this way and try to get these clients? And why wouldn't that work? And, you get some founders and like, no, that's not what we're doing. We're going to this market. We're going to do this market. We're going to do these things. We're going to make our money. And then maybe we'll go and look at that. Or you have some founders and will be like, oh my God, like the shiny ball object. And they're like, no, that would be great. Yeah, we haven't even thought about that. Like, we're going to go right forward and we're going to start building product. We're going to do this and that. And we're going to hire. It's like, no, like focus, do what you're doing. You got in front of us because we like what you're doing, and keep doing it. And you're going to be successful.
Yeah, no, great points. And we're kind of closing here. It's been a great discussion, but as we part ways, I'll ask one final question, and that is, what advice can you give? And you've given lots of good points already, but any parting thoughts to help startup founders kind of navigate and prevailing through due diligence in general? I'll start with you, Joseph. Any kind of last minute words of wisdom?
I want to give the analogy. So after this conversation, you might think you need to do everything. You have to get everything done and make everything perfect. But remember, to be a successful team, to be a championship team, you don't need all-star. So the thing is, we're talking about all the different type of characteristics, different type of industry, different kind of stages. So it's like an NBA championship team. The final MVP could be a guard, could be a forward, could be a center, but you have to understand what do you have and what kind of game you're playing and build a system surrounding the key advantage you have. So back to my earlier point, understand who you are and what your competitive edge is and build the key elements around that. So for some industry, traction is not important. For some industry, traction is so important because you need the momentum. So understand where you are, identify your key players and your core competence. And the other just could be common in the industry, like a go-to-market strategy. It could be the same go-to-market strategy. The social influencer could be the same. So understand where you are and focus on the compelling reason, and that's a key message you're going to sell. So you don't have to have a long roster of all-star players, but understand, build a dynasty, build a championship team with a few elements, and identify the key elements you have. I think that's the first step.
Okay, perfect. Thank you so much. And Connor, any parting thoughts or words that you might offer for entrepreneurs?
Yeah, I mean, I agree with Joseph completely there. I mean, I think it's really just know your business better than everyone else. I mean, you need to know every part of the business down to, the interns. You got to know what people are doing. You got to know how it functions. You got to know how everything works together. And then you have to just really be that driving force. You have to be the one that gets the people excited. You got to keep them confident because especially in a new business, you have a sales team. They might not be selling right away because the product's not there. They might get their heads down, but you got to come into those all hands calls and you got to pump people up and saying, this is what we're doing. And then on top of that, you got to, at the same time, know the business well, but dumb it down. Like you get in front of investors and you'll leave a meeting and this person's going off in the weeds about his technology and the IP and the AI. It's like, we don't care about that really. We want to know what the value proposition is. Are you going to change the world? And ultimately, are you going to make us money? And that's what we want to know, and make it very simple. I'm going to change the world. This is how I'm going to do it. And this is how long it's going to take for you to get money. Yeah. And people are going to be like, that's great. I see that. I understand that. And I like that.
Got it. No, perfect. And Allison, I'll kind of go to you last, but any parting advice?
Yeah, I think that I always go back to this core idea of have a very clear problem that you are addressing and the solution that you're providing. If there is no problem or there is no clear solution, how do you expect, other people to buy into it? And I think that both of you already have kind of talked about this, and I'm just making this extra clear, which is, you want to be very compelling about it and clear. And sometimes you might come in with a problem or an industry, that the people in front of you, the investors you're speaking to, might not understand. Help them understand and help them understand the opportunity, right? You can go and say, okay, you might not understand this. Don't say that, but this is what we're solving. This is it. And there's a huge opportunity here. And a lot of times I advise female founders, other founders that might be having a company or a product solution that the general population might not understand, but there is a huge market for it. And I say, help make sure that those people understand, because you have something great, and make sure that greatness is coming through. So figure it out, go back to your core, the problem, the solution, and why you are going to succeed and, make a great company return and so on. So that's I think one piece of advice.
Okay, no, that's perfect. Well, thank you all today, and I think this has been very, very helpful, and would really appreciate all the advice, especially for the entrepreneurs that are watching, and all the advice for the investors watching on due diligence. So, thanks again. All right, bye bye.
Thank you.
Thank you.